Hello, everybody. Kevin Lynch here from Westminster Wealth Management. I'm going to talk about savvy tax planning and retirement today. We have quite a bit of information to get through. Just to let you know, I do these presentations in libraries usually to invite the public to them. And hopefully you'll garner some information from this that'll be useful for you in your tax planning that you do for your retirement years. So firstly, what I like to do is start off with a little brain teaser, and I'll just give you a moment to read through kind of this. Well, we'll read through it together. Let's look at Bill. He's retired and has taxable income of $42,275. So if you go over to my little tax filing chart there, a single filer, that $42,275 would put him in the 22% bracket, because you see it goes between 41,776 and 89,075. It includes, and this is important, the type of income that it is, to give you some insight into the calculations. So it includes $38,000 of IRA income plus $25,000 in Social Security income benefits. He taps his IRA for an extra $1,000 because he wants to go on a concert road trip. So how much will he pay in taxes on extra $1,000? Seems pretty straightforward, right? So $1,000 extra dollars, he's in the 22% bracket. Well, he should pay $220. Seems pretty straightforward, right? Well, no, that's not what he pays. He actually pays $407. So, and I also would caution folks, I'm not a CPA. I do tax planning, not tax advice. Tax advice is very different. That's what CPAs do. I kind of do what if analysis. That's what I do from a planning perspective, and I have software that helps me do that. But interesting, right? It's not 22%. It's more like 40%, 40.7 to be exact. Now, why is that? Well, that's because we have some goofy things in our IRS, in the tax code, the IRS tax code, that folks should be aware of. Because, for example, in my example here, where he took $1,000 of income from an IRA, that's a taxable account, he could have taken that $1,000 from a Roth IRA or the cash value of a life insurance policy and not paid any additional tax on the money, because those two elements, those two areas or accounts are not taxable. So just to give you an idea, just you want to know kind of how the rules work. So, we're going to talk about, and what I have found best to do is to break this down into kind of 4 stages of retirement. In other words, if you're of a certain age, you probably should be looking at these things. If you're of a different age, you probably should be looking at these things. I have found that that's the best way to get your arms around this. And that said, if there's an age here or a stage here that's really not applicable to you because you're younger than that or over than that, well, then perhaps you could forward this on to a brother or sister or a friend or a neighbor who might benefit from it. So please be free to share kind of what I'm doing here with others, because I think it's important that as many people hear this as possible. I also have to make sure that I disclose to you that First Heartland Capital is my broker-dealer. You see it there right under my name. I am a licensed individual, and I must share that with you whenever I speak in a venue such as this. So next, I'd like to speak about, and let's look at the stages. Well, let's first make sure that you seek professional guidance on this information. Again, I am not a CPA. I do not offer tax advice. I offer planning services from tax perspective. We're going to talk about traditional IRAs. We're going to talk about IRAs. And from a state tax perspective, this presentation I'm doing today really focuses around the federal taxes, okay? So I'm in New Jersey. I know New Jersey has state income taxes. I'm not focusing on that. I am focusing really at the federal level, so just be aware of that. So what's going on out there? Well, world has gotten a little more complex, and certainly if you're in the distribution phase where you're taking money out of the accumulation phase, that's the phase that you just spent the last 30, 35 years, 40 years saving. Now you're distributing those dollars to you. So taxes in accumulation phase, savings, versus taxes in the distribution phase, spending, are very different. And you want to make sure that you understand the differences so you don't lay susceptible to the gotchas that are out there. Some other things that are going on at this stage of your life is that child tax credits may be gone for you. Kids may have flown the coop, and maybe they've come back. Who knows? Mortgage interest deduction. Well, many folks have their mortgages paid off, so now we don't have that deduction anymore. The tax-free employer-paid medical insurance is now turned over as something called Medicare. Contributions to 401ks, 403bs, 457s. Well, there are deductions you could take. Well, listen, if you're retired, you no longer have those deductions. So what I have found is that many people have this high octane income. And what I mean by that is that it's not offset by anything. There's no deductions anymore, or very few. Now what you have is Social Security. That's an income stream to you. RMDs, those are required minimum distributions, which the Secure Act just changed from being a requirement to take that income from age 70 and a half to now age 72, which is good because now you have another 18 months to allow your accounts to accrue. Paying for Medicare. Okay, that's new to people. That's a brand new healthcare system for those 65 and older that aren't working anymore. And potentially long-term care, another expense that you could have in retirement that you really didn't think about in your 20s, 30s, or maybe even your 40s and 50s. But now, especially if we've seen a loved one have a need for long-term care, i.e., helps with the activities of daily living, dressing yourself, feeding yourself, bathing yourself, being able to get from a walker into your chair or out of bed into your wheelchair. That's transferring. These are things that we never were really exposed to, but we may have had a loved one that had that exposure, and you may have been kind of a helpful person in that regard with the needs that they may have had. But long-term care is new to folks too. So people, what I have found, often pay more in taxes in retirement than they expected to pay because of a confusing system that treats various income types differently and contains hidden taxes and penalties. I'm going to go through some of those in the presentation today so that people are more aware of what to expect. And because the tax exposure will change throughout, those stages, there are different things you do at each stage. And that goes towards developing a solution as far as what you want to do at the various stages. These are the stages, by the way, that I've broken it down into. Kind of have pre-retirement, early retirement, middle retirement, and late retirement. The pre-retirement, those are kind of your biggest savings years, if you will. Maybe you're finished paying college tuition. Maybe you've finished paying the mortgage and you don't have these higher expenses anymore. It's a great time to work and save years, as I call it. Then we get early retirement. I kind of call those the go-go years. You're very close to retiring, if not retired, and you're traveling more. You're getting out there and doing the things that you saved up to do. Middle retirement, go slow years, I call those. They may be years that, you still go on trips, but maybe not as often. Maybe it's once per year. Maybe it's not on an airplane. You're staying more closer to home. And then late retirement, I call that no-go years, 80 plus. And that's kind of, you're really, enjoying grandkids and that type of thing, hopefully, but you've aged and you're in that segment of life. In each of these phases, I'm going to go through things you want to consider with regard to that age group in there or that stage and how it fits into tax planning. I find that many folks are kind of have some surprises in retirement. I named 4 here, which seem to be the most common. Inflation. People don't accurately calculate how inflation will impact their retirement. And let me just say, inflation right now is in the headlines. Inflation, it's depending on the periodical you read, 7.5% currently. So that is one thing you want to make sure you gauge and you keep track of is inflation. Longevity, that is yet another one that people, oh, I'm not going to live that long. That's what I have a lot of people saying. Yet here are their parents or a brother or sister living well into their 80s and sometimes into their early 90s. So that DNA is then passed on to you somewhere. So you're going to live longer than you might expect, and you must plan accordingly. Expenses. I've seen people not properly allocate or properly account for what they cost. And that's basically, what is your budget? And I encourage people strongly to have a written budget. Do not do it up here. Do not do it by memory. Have it an Excel spreadsheet. Many people know Excel. If not, hey, just list your expenses. If you want, you can call my office at 908-904-4100. We'll send you a template that we like to use. And the reason I like the template is that it forces you to think about the various categories instead of remembering the various categories. Like what I have found is many people forget about their HOA expenses, homeowners association expenses, and they fail to put that on their budget. It's just something that I don't know why, but a lot of people seem to overlook that. But put your budget together. And lastly is healthcare. I have found that people underestimate the costs of healthcare in retirement. And I do a presentation on Medicare. And let me let me just tell you this: Medicare does not pay for everything. A lot of people think that, oh, I'm a Medicare now, it's going to cover. Well, let me tell you, Medicare doesn't cover vision. It doesn't cover dental. It doesn't cover eyeglasses. Well, that's vision. But you get what I mean. It does not cover everything. And not only that, there are deductibles and copays you have to pay with Medicare. So just be aware that, healthcare costs, don't underestimate what those expenses are. And I do a class on Medicare as well. And I would encourage people to please come to that class, because I do kind of an overview of Medicare, when you have to sign up, kind of how you'd budget for it and that type of thing. I think you'd find it very beneficial for yourselves.